Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, welcome back to another episode of ETF Spotlight. I'm Daniel Snyder from Seeking Alpha. Today we're diving into the world of tech, but not only tech plus a little bit of rich, healthy yield. All these strategies that we've seen come across through various episodes of ETF Spotlight. Well, today we have the joy of talking to John Burrello. He is from Invesco. He's the senior portfolio manager over there. We're diving into the QQA ETF, which is that Invesco QQQ Income Advantage ETF. John, thank you so much for taking the time to speak with us today.
Thanks for having me, Dan. I'm excited.
So let's start at the origin story. I mean, this is one of the newer kind of ETF funds to the market. I believe it was July, let me double check here, July of 2024 when this thing launched and hit the exchanges. Where did this fund come from? Was there a need from investors? Was it something Invesco saw internally? Can you kind of give us the background?
Yeah, absolutely. So we actually started deploying what's now called Income Advantage back in 2018 in some of our multi-asset portfolios that were looking for income from equities. And the genesis of this is that we were, like most traditional investors, relying on dividends for extracting yield from the equity market. And we found ourselves overweight sectors like utilities or MLPs or mortgage REITs, corners of the market that tend to have maybe a little more volatility than the broader market does, but also a value bet. So we didn't have exposure to the growthier parts of the market that have been driving upside for the past decade and some of the innovation that's out there. And so when we looked at our portfolio, we said, is there a way for us to really get income while staying diversified, maintaining exposure to some of the more growthier segments of the marketplace, and not have kind of this value tilt to the portfolio? So our background, my background is within option-based strategies. I've been managing option-based portfolios for over 20 years. And so that's where we turned, was to, having a conservative option overlay approach to getting that income, reducing downside risk. And then now we're able to, combine two concepts you don't normally see, which is NASDAQ 100 growth-like exposure with income and less risk.
Now, you said the word conservative, but a lot of people hear options, they think risk, right? Yeah. So they're very, and especially when you're starting to throw, 10, 11, 12% yield in their face, they're going, well, I've only ever been told high yield equals more risk. So what should investors know about, as you mentioned, trying to keep risk down in a fund like this? How are these yields possible with mitigating certain levels of risk?
It's a great point. And because the space is growing so fast, it can be hard to parse through all the different strategies that are out there to understand the design details and which ones truly are conservative. So I think a simple way to think about this is, number one, no leverage. Everything we do for QQA, fully covered, fully collateralized positions, structurally defensive. So we're built to outperform in down markets. That's what we saw relative to the NASDAQ 100 during April when we had a very sharp drawdown. Obviously, we're battle tested from, in that regard. So conservative starts with no leverage. But then there are other design details that are important as well to make sure that you're not taking on too much path dependency. So laddering the option overlay is really important too. And then having that balance of defensiveness with upside potential is really key as well for these types of strategies.
Now, you said that this is designed to withstand those pullbacks in the market, the bear markets, if you will. I hear that and I immediately go, there's no way. Like, stocks are going down, the yield has to come down. How is it that you can still produce the same level of yield in no matter what market?
The yield is being derived from option premiums, and option premiums tend to go up when markets fall. They actually get juicier and larger, typically when volatility picks up. But we've designed our strategy such that the yield actually does not fluctuate with the level of market volatility. We don't want the source of monthly cash flow that our investors have to be tethered to something like the VIX, or in the case of QQA, there's a version of the VIX, VXN, on the NASDAQ. Our yields are not dependent on the level of volatility. And that's because we're systematically, each day through our laddering process, adjusting the option strikes so that we are extracting the same amount of yield from the markets each day. And then again, smoothing that by taking, call it 20 bites at the apple every month. We're, extracting a consistent level of income, really regardless of market direction.
So you're not really looking at, because when you think about volatility expansion, you can see those premiums jump, of course, within the option chain. So it doesn't matter the volatility level. You're able to say, this is the premium we're going to get, and the delta could be whatever along the way.
Yeah, when the prices of the options go up and the premiums we collect rise, we'll push those options further out of the money so that we're extracting the same amount of yield. And that's because we really prioritize total return. We're not only about distributing too much income. When we think about this as balancing this trade-off between income, market participation, and defense, those three things. If we go too heavy on income, and when option prices go up, just collect all that yield and distribute it out, that's how you can lead to NAV erosion, or you have an ETF price that's always falling because you're not careful about distributing yield. In our case, we want to be really thoughtful about growing investor capital at the same time that we're distributing these attractive yields on a monthly basis.
Now, this is a better time than any to talk to you specifically around tech, right? Because we've been watching this massive AI run. You can't avoid it. Any single week is what everybody wants to talk about. We've had some pretty big recent names within the stock market come out saying that the AI is starting to feel like a bubble. It's starting to be reminiscent of 1999. They're starting to show warning flags. A lot of these people are coming out starting to say this now. Just kind of curious, what are your thoughts? I mean, you're operating the tech-focused income space here. So are you worried about tech at all?
It's a great question, Daniel. So the way we think about this is that's tech uncertainty, right? So we have two types of investors in QQA. One type has already been invested in the NASDAQ 100. They've already kind of ridden this wave up in tech, and they're starting to get concerned. Hey, is now the time to take some chips off the table, have a way to reduce some of my risk, add a little cash flow. So these are investors that already have benefited, and now it's their stage of their life where they're just worried and they want to de-risk a bit, but they don't want to completely miss out. If this AI boom does come to fruition, there's another 10 years of great bull market exposure. So we'll give them some participation, but we are reducing risk by, call it 20 to 30% relative to the NASDAQ. Now, the other type is the people who are maybe amongst the $7 trillion that are sitting in money market funds that are not fully invested. They kind of missed this rally so far, and they're saying, well, gee, I see in the headlines all of this excitement around AI and other innovations, but is now really the time to go all gas, no brake? Well, not really. This might be QQA is a way to get a foothold into that exposure without going full risk, and you're getting kind of paid that monthly income, paid to wait and carry that exposure, benefiting in some upside participation as well.
Yeah. Now, correct me if I'm wrong, but as we've been talking about, the fund uses derivatives, including equity-linked notes. So for an investor or somebody watching right now that may not understand equity-linked notes and how they're beneficial for the fund, could you just give a 2-second kind of summary of how those are utilized?
Equity-linked notes allow us to give you pure bona fide income without being in a tax straddle position and without giving return of capital. So it's an efficient vehicle for transparent income collection from the equity markets. When we're trading in the portfolio, it looks and feels to us like we're trading options. Invesco is in full control over customizing all of the details of those option trades, and then it's booked as an equity-linked note or an ELN. Now, the way to think about this is we have downside protection in those ELNs that limits their exposure to a maximum by prospectus, a maximum of 10% of the fund. Currently, it's only about 5% of the overall portfolio is in ELNs. And that's nice for investors because they have full transparency on the maximum they could ever lose from the option portfolio. So meaning if the index were to fall to zero, or if the banks that we trade the ELNs with were to all go out of business within a 30-day period, you have a maximum of currently about 5% exposure to that risk. That's transparency that's hard to get if you're trying to parse through kind of the notional value of option positions in the portfolio. ELNs are non-levered, fully funded instruments where we know the maximum we could ever lose.
Yeah, thanks for clarifying that. And I also want to make sure that, not everybody here watching this show is deep in the derivative space. But earlier you were talking about the strategy and the laddering aspect of how you approach the strategy. Could you just dive into the laddering and what that is for people so they know that?
This is one of the most important design choices to look for in option income. So more than half the funds in this space will trade the whole overlay all at one price on, say, the third Friday of the month. Maybe they do it weekly. Either way, there's path dependency associated with that. You can think of QQA, and by the way, RSPA and EFAA are the other two income advantage ETFs we manage on S&P Equal Weight and MSCI EFA. All three ETFs follow the same process, 1 month options. But if there are, say, 20 business days or trading days in a month, we're trading 1/20th of it each day. So today we're recording on October 6th. We'll trade for expiry on November 6th. Tomorrow we'll do 1/20th, targeting November 7th, etc. So that process really smooths the path dependency, reduces the risk, also allows us to be much more adaptive. Because, think about April again. What if we only traded the whole overlay on the third Friday of March? Then you get this event, Liberation Day, and all that volatility in the first week of April. We don't want our hands tied all the way until third Friday of April. We were able to adapt, change those strike prices, set ourselves up to capture, more of that rebound that ended up happening. That's how we can really add value through laddering over time.
Yeah, no kidding. So let's get down to who is the right investor for a fund like this. Is it purely somebody saying, I want income? Are they looking for the capital appreciation? Who are we talking to here?
It's a wide variety of investors. I already touched on two of them. People who have already benefited from the NASDAQ 100 growth or equity market growth. They want to de-risk a bit. There are also those that are on the sidelines that are concerned about jumping in now, given where valuations are, or kind of the riskiness of the market that we see out there. But it's also people that want a source of monthly cash flow that are using income advantage as well. So it's not just retirees, although obviously that's a big segment of the marketplace that wants steady yield. It might be entrepreneurs or younger people that want, an added source of income on top of their kind of W-2 income that they're getting at their job. We're seeing a lot of people use them for that as well. But first and foremost, take a step back. It's about participating in equity markets with less risk and with the addition of monthly income that is not rate sensitive. So we really don't care what the Fed is doing. It's not tied to interest rates. This is another source of yield that's diversifying for people's cash flow.
And that's great to hear you say that with all of the Fed rate cutting cycle going on that's kind of kickstarted. You want to make sure, because that's one of the inputs for option pricings, right, is the interest rate and how it can be used to calculate. So let's wrap things up here. You've been more than graceful with your time, but where do we go from here, right? This is the way I kind of like to wrap these up is you're in a space right now that we've been talking about for a long time. It's had an explosion over recent years of using various option strategies to get that income out of the market by selling options here, doing a ladder approach like you're talking about. There's so much competition now. Where do we go from here, and how does Invesco play a part in that?
I think the space will continue to grow, and it's because the outcomes that we're talking about should always be in demand. It's really simple. People will always want income, will always want defense. Now, the key, though, is that all of these different option income portfolios that are being launched, they're all designed differently. So it's important to look under the hood, see what's best for you. What I would mention is key things to look out for. First and foremost would be a balance of that income and growth. Do not be enticed by yields that look too good to be true, because they are too good to be true. You'll end up getting your own principal return back to you and be charged fees in the process. We always like to remind investors that there is no free lunch. So balancing income and growth is really important. And then these other elements we've already discussed, ladder, et cetera, that's how you get consistency on those outcomes of income and defense.
All right, John, let's go ahead and wrap it up there. John Burrello, everyone's senior portfolio manager over at Invesco. We were talking about the QQA fund here today. Go ahead and add that to your watch list. Check it out here on Seeking Alpha. Give it a follow. And maybe if it's right for you, add it to your watch list. But John, can't thank you enough. Thank you for diving deeper into the strategy, because I know some funds out there, they like to just try to keep it surface level. So I appreciate the time today. And everyone, thank you for tuning in to this week of ETF Spotlight. We'll see you here again soon. Take care.